I want you to imagine the broader Indian market over the last year as like a luxury cruise ship that just hit some incredibly rough water.
Oh, yeah. It's been brutal out there.
Right, like the tech stocks on board are seasick, the mid caps are actively taking on water, and, foreign investors are just scrambling for the lifeboats. It is a very tense environment for anyone paying attention.
Absolutely.
But then, down in the engine room, just completely ignoring the storm, there is this quiet, relatively unknown coffee manufacturer. And they
Uh-huh.
haven't just weathered the waves. They have somehow, doubled their engine power.
Yeah, the contrast is honestly stark.
Really?
We're looking at a financial environment right now that is just obsessing over global tariffs and, the next big AI leap.
Oh, definitely. Everyone's looking at tech.
Right. So finding a traditional asset-heavy manufacturing company that's compounding wealth at this rate is highly unusual.
Uh-huh.
And it tells us there is a very specific mechanical advantage at play underneath the surface.
Which brings us to the mission for today's deep dive. For you listening, especially if you're someone who wants to just cut through that market noise and understand the actual gears of a successful business, we are unpacking a real analytical masterclass today.
It really is.
Our grounding source is an article published just today, actually, April 10th, 2026, by Shubham Singh. It's titled, The Quiet Outperformer: Why CCL is Near Its 52-Week High While the Market Burns.
Great title.
Yeah, it hits hard. So we are going to decode the DNA of this seemingly boring B2B instant coffee manufacturer that pulled off an incredible run while the rest of the market was effectively just in free fall.
It's a phenomenal case study in structural resilience. I mean, in a world chasing hypergrowth startups, this company is quietly teaching the market a lesson in how a fundamentally sound business model can just hide in plain sight.
Hide right under our noses.
Exactly. They've essentially built an economic fortress using geography, pricing power, and this totally under-the-radar distribution network.
Okay, let's lay out the numbers for everyone just to show how strong that fortress is, because the contrast is staggering.
Yeah, it really is.
So as of April 7, 2026, CCL Products was trading at 11,139 rupees and 20 paise. That is up over 105% in a single year.
Wild.
Right. And to put that in perspective for you, the broader Sensex delivered a microscopic 3% return over that same period. I mean, CCL even hit an all-time high of 11,183 rupees and 45 paise this month.
Yeah, the momentum is huge.
We're talking about Q3 FY26 revenue hitting 1,050.56 crore rupees. That's a 38.52% jump year on year. And their total market cap, it grew almost 100%, 98.2% to be exact, to just over 15,000 crore rupees.
Which is just massive. And I think the immediate question those numbers raise for anyone listening is, how? How are they so insulated from all the domestic panic?
Yeah, exactly.
Well, a foundational piece of that puzzle is their geography and their target market. So CCL is the world's largest private label instant coffee manufacturer, but they operate as a pure play exporter.
Meaning they ship basically everywhere.
Right, to over 100 countries.
Yeah.
And because they earn their revenue in foreign currencies like dollars and euros, a weakening Indian rupee, which normally absolutely terrifies domestic markets, actually acts as a powerful tailwind for them.
Oh, because of the conversion rate.
Exactly. When they convert those dollars back to rupees, their earnings get an automatic boost. And furthermore, their foreign institutional investor shareholding, the FII, is incredibly low. It's sitting at just 11.24%.
Oh, wow. Meaning there is no looming wall of foreign money waiting to just pull out and crash the stock at the first sign of macro trouble.
Precisely.
Instead, they have this massive runway for institutional investors to start buying in as the story actually gets discovered.
Right.
Okay, let's unpack this. Because the real secret sauce here isn't just that they export coffee, it's the pricing mechanism they use. The source highlights their cost-plus model.
Yes, the cost-plus model is everything here.
Right. So think of it like, okay, imagine a freelance graphic designer who bakes the cost of their expensive software subscriptions directly into their client invoices. If Adobe suddenly doubles the price of Photoshop, the designer doesn't eat that cost.
No, they just pass it on.
Exactly. They rewrite the contract and pass the exact difference onto the client. The designer's actual hourly profit, like their real take-home pay, stays completely protected.
I like that. The freelance designer is a good baseline, but imagine if that designer was also, writing the underlying code for the client's entire operating system.
Oh, okay. So way more embedded.
Exactly. The difference here is the sheer depth of integration. CCL isn't just shipping generic, interchangeable coffee beans. They are selling to premium brands across the US and Europe, and they spend literally years working with these clients to develop highly specific, custom flavor profiles.
So they're tweaking it perfectly for each brand.
We are talking about precise blends of freeze-dried and spray-dried coffee that fundamentally define a brand's signature taste.
So it's honestly more like a complex chemical formulation than just, bagging up an agricultural crop.
That is exactly it, and that is the core of their moat. A premium European coffee brand cannot simply jump to a cheaper manufacturer in South America just to save a few cents on the kilo.
Because the coffee would taste different.
Right. If they do, the flavor profile changes, and their customers immediately notice the difference. This creates immense switching costs. Because the European brands are so locked in, they are willing to absorb those passed-on raw material costs.
Which gives CCL a crazy advantage.
It does. This structural setup completely separates CCL from consumer giants like Nestle, who have to worry about shoppers rebelling at the supermarket checkout. And it separates them from plantation owners like Tata, who bear the total risk of bad weather and crop failures.
Right. They're not farming it, and they're not selling it to the final guy.
Exactly. CCL sits very comfortably right in the middle.
So this cost-plus model acts like a perfect financial shield on paper. But, paper shields usually burn when things get really hot. And in FY25, nature basically handed the coffee industry a blowtorch.
Oh, it was a disaster.
Right. Did the math actually hold up in reality? Because we saw massive supply disruptions and terrible harvests in Brazil, which is obviously the undisputed heavyweight champion of coffee production.
Yeah.
And that caused raw green coffee prices to just absolutely skyrocket through FY25 and FY26.
Yeah, the entire supply chain was upended. When Brazil suffers a drought or a frost, the global supply of Arabica and Robusta beans constricts violently. Raw material costs for food and beverage companies usually decimate profit margins during these cycles.
Because they can't raise prices fast enough.
Exactly. Companies cannot raise their retail prices fast enough to cover the shock. Prices eventually stabilized recently in the 3,600 to 4,000 rupee range, but the climb up there was brutal for the industry.
Right. And according to the source, CCL supposedly navigated it fine. But I have to push back here.
Okay, go ahead.
Because looking at the actual data, I see something that looks like a glaring red flag. During this exact period, CCL's overall profit margin percentage swung wildly. I mean, it went from 19.53% in Q4 of FY25, plunging down to 15.06% in Q1 of FY26.
Right.
That is a 444 basis point swing. And for the listener, a basis point is just 0.1%. So we are talking about a profit margin dropping by roughly 4.5% in a single quarter.
Wait, if their profit per kilo is so magically protected by this cost-plus model, why are we seeing that kind of margin collapse?
I totally understand why that looks alarming on a spreadsheet. It really does. But if we connect this to the bigger picture of how inflation warps accounting, we see that this is actually an optical illusion of the math.
An optical illusion?
Yeah, it's one of the most misunderstood parts of the CCL story. So let's break down the arithmetic of the cost-plus model during an inflationary spike.
Okay, let's hear it. Imagine your base cost for the raw green coffee required to make a kilo of instant is, say, 100 rupees. Under your contract, you add a fixed profit of 20 rupees. So your total revenue for that kilo is 120 rupees.
Okay.
In this scenario, your profit margin is roughly 16.6%.
That makes perfect sense. 100 goes to the farmer, 20 goes straight in my pocket.
Exactly. Now, Brazil has a terrible harvest. The global shortage means your raw coffee cost shoots up from 100 to 200 rupees.
Ouch.
Right. But because you have that ironclad Class Plus contract, you don't take a hit. You still add your exact same 20 rupee profit on top. You are not making a single penny less per kilo.
Okay, I'm with you.
But look at what happens in the top line. Your total revenue for that kilo is now 220 rupees. Your 20 rupee profit is now a much smaller slice of a much larger pie. Mechanically, your profit margin percentage drops to around 9%.
Oh, wow. So the absolute cash they are depositing in the bank per kilo hasn't degraded at all.
Not a cent.
But because the top-line revenue number artificially inflated just to cover the expense of raw beans, the percentage looks terrible.
Exactly. The underlying cash generation was rock solid. The top-line growth looked much stronger than it actually was because of those passed-on costs, and the margin percentage looked much weaker.
That's fascinating.
While traditional competitors were bleeding real cash trying to subsidize expensive beans, CCL was just experiencing a mathematical quirk of percentage calculation.
Right.
You really have to look past the headline margin percentages and understand the actual mechanics of cash flow.
That is a phenomenal distinction. I love that. So, okay. We have established they possess this incredibly resilient, battle-tested model that survived a massive supply chain shock.
Yes.
But, merely surviving a shock isn't the same as thriving. A doubled market cap demands future growth. Investors aren't paying for yesterday's stability, they're paying for tomorrow's expansion. So where is that growth actually coming from?
The engine for that growth is the aggressive yet quiet capacity expansion they have been executing over the last few years. They are currently sitting on a significant amount of fresh, completely underutilized factory space. In India, they recently commissioned a 16,000-ton spray-dried expansion. And over in Vietnam, which is a highly strategic hub for coffee, by the way, they added a 6,000-ton freeze-dried line.
That's huge.
Yeah, bringing that specific facility up to 36,000 tons. In total, their global capacity is now approaching 77,000 to 78,000 tons.
And according to the Q3 FY26 data we have, their current utilization of all that machinery is only at 65 to 70%. But management is targeting 85 to 90% utilization over the next 2 years without needing any major new capital investments.
Right.
Here's where it gets really interesting, because this introduces the concept of operating leverage. Think of it like renting out a massive 500-seat movie theater. You have to pay the fixed cost to rent the building, hire the staff, and power the projector, regardless of whether there are 10 people in the audience or 400.
The rent and the electricity are sunk costs, yeah.
Right. So going from 10 tickets sold to 50 tickets sold helps you slowly pay off that rent. But once you cross the threshold and actually cover those fixed costs, the math changes completely.
Dramatically.
Going from 300 tickets to 400 tickets, that extra 100 tickets is almost pure profit. You don't need to buy a second projector. You don't need a second building.
Exactly.
CCL has already built the factories. As they push that utilization rate from 65% up to 90%, every additional ton of coffee they pump out drops incredibly efficiently to the bottom line because the expensive infrastructure is already paid for.
And the mechanism they're utilizing to fill those factories is perhaps the most ambitious part of their entire strategy.
Oh, the brand pivot.
Yes. They're not merely relying on signing more B2B supply contracts. They're actively attempting to morph from a faceless background supplier into a complete, fast-moving consumer goods, or FMCG brand powerhouse.
Sure.
We are talking about a massive business-to-consumer pivot.
Yes, the Continental Coffee brand, they're aiming to double their retail outlets from 1.5 lakh to 3 lakh.
That's a massive jump.
And the growth rates between the two sides of the business really tell the whole story. The B2C side is surging at 35 to 40% annually, while their traditional B2B business is just chugging along at a steady 15%.
Right.
And they are not limiting this consumer push to India either. They acquired Percol in the UK and Löfbergs in Sweden.
Those acquisitions are so critical to understand, because building a B2C brand isn't just about roasting good coffee. It is a brutal, expensive war for supermarket shelf space.
Yeah, getting into the grocery store is the hardest part.
Exactly. When they bought Percol and Löfbergs, they weren't just buying logos. They were buying the barcode slots on the shelves of European grocery stores, which is notoriously difficult for a new entrant to secure.
It skips the line.
It gives them direct access to the European consumer without spending a decade trying to negotiate with retailers from scratch. And this is key. They are expanding beyond coffee entirely. The recent launches of Malgudi snacks and iced tea demonstrate that they are leveraging their growing distribution network to push multiple higher-margin product lines through the exact same pipeline.
It is a complete corporate metamorphosis. But look, as rigorous learners, we cannot just be cheerleaders for the stock. We have to look under the hood, read the fine print, and ask, what could cause this compounding machine to break down?
Because there are always risks.
Definitely. And there are some sharp edges in this report. First up, debt. Gross debt is sitting at 1,448 crore rupees. They only have about 200 crore in cash, leaving a net debt of 12,248 crore.
Which is substantial.
That is a heavy burden, highly sensitive to interest rate changes. Then there is the working capital trap. FY25 saw negative operating cash flow that ballooned to a negative 228 crore rupees as their inventory cycles got heavily stressed.
We definitely need to unpack that working capital trap because it is the hidden cost of their business model.
Please do.
Think of working capital like the plumbing of a business. CCL has to buy massive amounts of raw coffee beans up front from farmers across the globe just to secure their supply. That is, cash out the door immediately. But their B2B clients, those big European supermarket chains, might take 60 or 90 days to actually pay their invoices once the instant coffee is delivered. That delay is known as trade receivables.
So they're basically constantly bridging the gap between paying the farmer today and getting a check from the supermarket 3 months from now.
Exactly the issue. When raw coffee prices spiked due to the Brazil crisis, CCL had to tie up.
And that cash flow pressure leads us right into the valuation. The stock is trading at a multiple of roughly 37 to 40 times price to earnings. For context, the broader sector average sits around 23x.
Yeah, that's a steep premium.
So, what does this all mean? If they are trading at a 40x PE in a 23x sector, are we looking at a stock that is currently priced for absolute perfection? Like a scenario where even one tiny misstep in their FMCG pivot or a delay in pushing that factory utilization to 90% could trigger a massive sell-off.
I mean, there is very little margin of safety at a 40x multiple. The market is pricing in the successful execution of both the factory utilization and the B2C expansion. But what's really fascinating here is that the biggest potential risk to that premium valuation actually comes from something that sounds like incredibly good news.
Really? Like what?
A massive global coffee surplus. Agronomy forecasts are currently pointing to Brazil producing record coffee surplus in 2026.
Wait, an oversupply? Wouldn't a surplus crash the price of raw green coffee? I would think cheaper beans would be a blessing for a coffee company.
It would be a blessing for a traditional consumer brand, because plunging raw material costs mean higher profit margins. But remember, CCL's cost-plus shield.
Oh, I see where this is going.
Yeah, the very mechanism that protected them during the shortage is going to optically hurt them during a surplus. If Brazil overproduces and input costs plummet from, say, 4,000 rupees down to 2,000 rupees, CCL is contractually obligated to pass those savings back to their clients.
Wow.
Their absolute profit of 20 rupees per kilo remains completely untouched, but their total top-line revenue numbers will shrink mechanically.
Because they aren't inflating the invoice to cover expensive beans anymore, the math illusion works in reverse.
That is the paradox of the cost-plus model. It creates immense stability in actual cash flow, but it causes extreme volatility in revenue optics. If the broader market sees CCL's revenue shrinking quarter over quarter just because raw material costs dropped, investors who bought in at a premium 40x valuation based on top-line growth might get spooked and sell off.
They might just panic.
Exactly. They might panic, even though the actual underlying cash profitability of the business hasn't degraded a single cent.
That is a brilliant nuance to keep in mind, and it perfectly highlights why you have to understand the actual mechanics of a business, not just skim the headline numbers on Yahoo Finance.
Absolutely.
So, to summarize the journey we have been on today for you listening, CCL Products is basically a masterclass in how a supposedly boring B2B company can quietly compound immense wealth. They utilize a highly engineered cost-plus pricing mechanism to shield their profits from agricultural chaos.
Yep.
They are sitting on underutilized, already paid-for factories ready to unleash operating leverage. And they are utilizing smart acquisitions to stealthily build a B2C consumer empire right on European grocery shelves. It just proves that the most valuable insights rarely come from the loud, panicked market noise.
Never.
They come from looking down in the engine room at the quiet operators hiding in plain sight.
It is a remarkable transition from a background manufacturer to a frontline brand. But as they step out of the shadows and into the B2C spotlight, it leaves us with a lingering dynamic to consider.
Oh.
Something to really mull over as you watch this company evolve. CCL is aggressively pushing their own Continental Coffee, utilizing acquired brands like Percol and launching snacks to fight for prime supermarket shelf space.
Right.
What happens when their massive global B2B clients, the very brands who rely on CCL's factories to manufacture their premium blends, realize that their quiet, reliable supplier is suddenly fighting them for the exact same consumer in the grocery aisle?
Oh, wow.
Can a company successfully be the indispensable manufacturer and the direct retail competitor at the very same time?
Supplying the white label coffee to the supermarket and then putting your own brand right next to it on the shelf.
Exactly.
That is a dangerous tightrope to walk, and it reminds you that every aggressive growth strategy creates its own new set of frictions.
Very true.
Well, thank you for joining us on this deep dive. Keep looking past the noise, and we will catch you on the next one.